Hey everyone, welcome back to the deep dive. We're diving into a classic today, Benjamin Graham's The Intelligent Investor.
Yeah, it's considered like the Bible of value investing.
It really is. So we've got the introduction and the first four chapters here. Think of this as like a cheat sheet to understanding how to build wealth without falling for all those investing traps out there. We're going to really pull out the core stuff, about what real investing actually is, what inflation does, how it kind of eats away at your returns,
Right.
and how to build a portfolio, a real one that actually fits your life.
Exact.
Our mission here is to equip you, the listener, with Graham's foundational principles. What does he actually mean when he says intelligent investing? What dangers did he warn about? And, how should you, especially if you're like a defensive investor, how should you approach the market?
I think one of the things that's so interesting about Graham, and especially reading this in 2023, is he was writing this back in I think the first edition was in the 40s, and then he updated it in the 70s. So this is advice that has really stood the test of time.
Yeah, he's seen a few cycles.
Exactly.
All right, so let's tackle the big one right out of the gate. Investing versus speculation. Now, for Graham, he really boils it down to three things. One, in-depth analysis. Two, protecting your principal, your initial investment, not losing money. And three, achieving a satisfactory return. Now, all three of those elements, they're crucial, and that's investing. What's speculation? That's basically just gambling. He even compares Wall Street to a casino.
Yeah, where the house always wins.
Well, where the house often wins. And in this case, the house is, the brokers and the people who profit from all the trading activity. The key takeaway here for you as a listener is that true investing, it's not about those quick wins. It's about a really deliberate process, a process that focuses on safety and reasonable growth, not trying to get rich quickly.
Right. Yeah, he really wanted to emphasize the difference between trying to get rich quickly and building wealth slowly and steadily.
Yeah, and he was really worried about this, what he saw as like kind of an obsession with speed, right? Back in the late 90s, there was so much trading activity. People were buying and selling stocks incredibly quickly.
The turnover rates on the New York Stock Exchange and in mutual funds were just through the roof.
Yeah.
I mean, people were just trading constantly.
And he saw this as a hallmark of speculation, this short-term focus. Remember all those strategies that popped up back then, like the January effect, the idea that small stocks would jump in January?
Oh, yeah, I remember that.
Well, guess what? It kind of faded because as soon as everyone tried to exploit it, the opportunity just disappeared. And all those transaction costs ate away at any profit you might have made.
Right.
And, you see this kind of thing over and over again, these kind of speculative fads. They pop up, and they often lack that fundamental analysis and that focus on safety that Graham really emphasized.
Exactly. He had some pretty firm rules for people who did choose to speculate.
Oh, yeah. What were those?
So his first one was never confuse it with investing.
Makes sense.
And second, understand that it is risky if you take it too seriously. Don't bet the farm. And third, really strictly limit the amount of money that you put into it.
Okay, so like set aside a certain amount.
Right. He talked about this idea of a mad money account, maybe 10% of your portfolio at most that you can use to speculate, kind of play around with.
So you're not messing with your core holdings? Okay, that's a really interesting idea. All right, let's shift gears a little bit and talk about inflation. Now, inflation is like that silent thief, right? It eats away at your wealth over time.
It really does. It's kind of insidious. You don't really see it happening until it's too late.
Exactly. And Graham pointed out how easy it is for all of us to fall for what he called the money illusion. You feel good about the gains in your investments, but those gains are nominal. The actual purchasing power of that money might be going down because prices are rising faster.
Right. You might have more dollars, but those dollars don't buy as much as they used to.
Exactly. And what's interesting is, back then, inflation seemed pretty low, relatively speaking. We've seen a bit of a resurgence recently. But even when it was low, Graham identified some really persistent reasons why inflation is a recurring risk, like historical patterns, not just in the U.S., but globally.
And, the fact that governments often have an incentive to inflate their way out of debt.
Right, because it makes the debt easier to pay back.
Exactly. So for, anyone listening who's thinking about their long-term financial planning, it's really important to factor inflation into the equation.
Absolutely. And a lot of people think, well, stocks will protect me from inflation.
Right. But it's not quite that simple.
Yeah, Graham knew that. He knew that stocks are an imperfect hedge against inflation. So he suggested some other things that you might want to consider, like REITs, which are real estate investment trusts.
So these are companies that own income-producing real estate, things like apartment buildings, shopping malls, office buildings.
Yeah, and there are ways you can invest in these REITs through low-cost index funds.
Right. And that can give you exposure to the real estate market, which historically has been a pretty good hedge against inflation.
Not perfect,
Nothing's perfect.
but a good hedge. He also mentioned something called TIPS, Treasury Inflation Protected Securities. These are government bonds that adjust their value with inflation. So, if inflation goes up, the principal value of your TIPS goes up as well. And these can be really helpful in tax-advantaged accounts like your IRA or your 401k.
Yeah, they can be particularly useful in those accounts because you don't have to pay taxes on the inflation adjustments until you withdraw the money.
Exactly. So there are some tools, some specific tools that you can use to kind of fight against inflation. And the point is, stocks can help, but you don't want to just rely on them. You got to think about some other options too. All right, so we've talked about investing versus speculation. We've talked about inflation. Now let's move into this idea of market history, right? Because Graham really stresses the importance of learning from market history, but he also warns against simply assuming that the past is going to repeat itself.
Yeah, he was really skeptical of people who would just extrapolate past trends into the future.
Right, and you remember all the hype in the late 90s?
Oh yeah, I mean it was unbelievable.
Experts were coming out and saying the stock market's going to go up forever, right? And, everyone was talking about the Dow going to 36,000. Well, it did eventually go to 36,000.
Eventually.
Not before crashing a couple of times.
Yeah, a lot of people lost a lot of money along the way.
And Graham cautioned against that kind of thinking, right? He said projecting the future solely based on the past is a mistake.
It's like driving a car by only looking in the rearview mirror. You might be on the right road for a while, but eventually you're going to crash.
Yeah, I like that analogy. And, you see this time and time again. There was one analyst, Henry Blodgett, I think his name was, who was super bullish on these internet stocks, and he got in a lot of trouble for that.
Yeah, and Cisco, which was like the darling of the dot-com boom, its market cap went from like $500 billion down to like $100 billion in a matter of months.
It was crazy. It shows you how quickly things can change.
And how dangerous it can be to rely on those optimistic forecasts.
Absolutely. And, Graham was really big on this idea of investor psychology. He understood that people get caught up in the excitement, in the euphoria, and they start buying high and selling low.
Which is the opposite of what you're supposed to do.
Exactly. And he pointed to a few factors that really drive stock performance over the long term. Real economic growth, obviously, inflation, and then also the speculative mood of the market. He said that long-term stock returns, they're probably going to be somewhere around 6%, give or take.
Which is, not bad, but it's certainly not the double-digit returns that people were expecting in the late 90s.
Right. And, we saw what happened there. So managing your emotions, it's just as important as understanding the numbers.
Absolutely. If you can't control your emotions, you're going to make bad decisions.
All right, so let's get into Graham's advice on building a portfolio, especially for the defensive investor, right?
So he outlined two main approaches: active investing, where you're trying to pick winners and time the market, and then passive investing, where you're building a diversified portfolio and basically sticking with it.
Right. And he favored the passive approach for most people.
Yeah, especially for people who don't have the time or the inclination to do all the research and analysis that's required for active investing.
Right. And for the defensive investor, it's really about building that solid foundation, protecting yourself from those major losses, knowing yourself, staying consistent with your plan, keeping your costs and emotions in check.
Yeah, he really emphasized that. Knowing yourself, knowing your risk tolerance.
Right. And when it comes to actually dividing your money between stocks, bonds, and cash, that's what we call asset allocation, he didn't like these simple age-based rules. Like your age should be the percentage of bonds you hold.
Yeah, he thought that was way too simplistic.
Right, because everyone's situation is different. What's right for an 89-year-old with $3 million in the bank is going to be totally different for a 25-year-old who's saving up for a wedding.
Right.
And, having some cash on hand, regardless of your age, for those unexpected expenses, that's always a good idea. And he saw bonds as like a crucial cushion in your portfolio.
Yeah, he recommended at least 25% in bonds.
And that helps reduce the volatility, especially when the market takes a downturn.
Right. And, when you're thinking about your own risk tolerance, There are a lot of factors to consider. Your marital status, whether you have kids, any potential inheritances, your job security, your income needs, and how you would feel about potential losses.
Exactly, exactly. So he suggested a stock allocation range of 25 to 75% for the defensive investor. And then to maintain those percentages, he recommended rebalancing regularly, maybe every 6 months or so.
Yeah, that helps you avoid making emotional decisions and keeps your portfolio aligned with your goals.
Right. And he did say, 100% stock portfolio might be suitable for some people.
Yeah, but it's a very specific group. People who have a significant amount of savings, they've been investing for a long time, they've been through a few market crashes, and they have a really well thought out plan for managing their behavior.
And they've read Chapter 8.
And they've read Chapter 8.
Right, exactly.
Now, for bond investing, he generally recommended tax-free bonds outside of your retirement accounts, intermediate term maturities. And he also liked bond funds for most investors because they provide diversification.
Right. So you're not putting all your eggs in one basket.
Exactly. So as you're navigating this world of investing, keep Graham's principles in mind. Really distinguish between investing and speculating. Be aware of inflation's impact. Learn from market history without being a prisoner of it.
Yeah.
And really construct a defensive portfolio that truly fits your unique circumstances.
Exactly. It's all about finding what works for you. Right. So take some time to think about your own investment choices right now. Do they align with Graham's wisdom? Are you clear on why you've made those decisions? And have you considered setting up a regular rebalancing schedule for your portfolio?
Those are all great questions to ask yourself. And here's a final thought for you. Graham believed that your character, your discipline, your emotional control, those are more important than your intelligence when it comes to investing. So take some time to reflect on your own emotional tendencies with money. How do you react when the market goes down? How do you react when the market goes up? Understanding and managing your behavior, that could be the most significant step you can take towards becoming a truly intelligent investor.
Absolutely. That's great advice. All right, that's all the time we have for today. Thanks for listening to The Deep Dive.
Thanks for having me.